What happens when all 21 million bitcoins are mined? Bitcoin has a hard cap of 21 million coins, but when the very last bitcoin is mined, the change isn't theoretical. It hits real people, real companies, and real money. First, new bitcoins stop being created completely. No safety valve, no extra supply if demand explodes. From that moment on, every bitcoin in existence is already out there, or lost forever. Now, let's talk about miners, because this is where things really change. Today, mining companies make most of their money from block rewards, newly created bitcoin. Transaction fees are just a bonus. But once all 21 million are mined, that entire business model flips overnight. From that point forward, miners only earn transaction fees. So what actually happens? Some mining companies don't survive. Large mining farms running on expensive electricity suddenly aren't profitable anymore. They shut down machines, sell hardware, or go bankrupt, just like inefficient gold mines closing when prices drop. This already happens today during bear markets, and it would happen again, just more permanently. Other miners adapt. The miners that survive are the ones with ultra-cheap electricity-efficient hardware, long-term strategies. These miners don't rely on volume. They rely on high-fee transactions. Instead of validating millions of small payments, they prioritize fewer but more valuable transactions. Bitcoin slowly turns into a settlement network. Think of it like this. You don't use armored trucks to buy coffee. You use them to move millions of dollars. After mining ends, Bitcoin's base layer works the same way. Big institutions, governments, banks, and corporations use it to settle massive transfers. Everyday payments move to layers built on top, like lightning. What about security? If fees are high enough, miners keep mining. If fees drop too low, some miners leave. But Bitcoin adjusts. Mining difficulty drops, blocks normalize, and the network stabilizes again. The system doesn't collapse, it shrinks, then rebalances. And here's something most people overlook. By the time the last Bitcoin is mined, Bitcoin must already be valuable enough to survive on fees alone, or it wouldn't have made it that far. If nobody cared, miners would have quit long before 2140. Meanwhile, scarcity keeps increasing. Millions of bitcoins are already lost forever. Forgotten passwords, destroyed hard drives, dead wallets. With no new supply coming in, those lost coins quietly make every remaining bitcoin more valuable. So what does Bitcoin look like after the final coin? Fewer miners, but more efficient ones. Higher fees, but fewer on-chain transactions. Bitcoin used less for spending, more for settlement. A fully fee-driven network, powered only by demand. In short, when the final Bitcoin is mined, Bitcoin doesn't shut down. Mining companies don't all disappear. The network doesn't break. It just becomes more serious, more scarce, and more selective about who uses it, and why. And whatever Bitcoin becomes after that point won't be decided by its creator. It'll be decided by the people still willing to pay to use it.